Hello everyone, I'm going to take you through a brief overview of bonds. For students in financial management class, will come across bonds, or maybe you have come across bonds and you don't understand. So this tutorial will be very much important towards your comprehension of what a bond is. Yes. So bonds are fixed income securities. They are fixed income securities to mean that they pay a fixed stream of cash flows after a given duration. So these bonds are usually issued by government institutions or companies to enable them finance their projects. We have different terminologies that you need to understand for you to know what bonds are. One is yield to maturity, which is the interest rate charged by investors a bond. And then we also have coupon, which is a stream of regular cash flows paid by the issuing institution to a bondholder. Then we have the coupon rate, which is the rate at which the coupon is issued in comparison to the par value. Then you have the face value or the par value, the amount of money given to the investor upon maturity of the bond. And you also have the price, which is the amount of money that the investor pays for the bond. We have various categories of bonds. Corporate bonds are bonds issued by corporations or companies. Government bonds, bonds issued by government with maturity periods of more than 1 year. Bonds issued by government with maturity periods of less than a year called treasury bills. Then we have municipal bonds. These are bonds issued by municipalities. And then we have agency bonds, which are bonds issued by organizations affiliated to the government. Let's move to types of bonds. We have zero coupon bonds or par bonds. These are bonds that do not pay coupon. We have discount bonds, bonds that pay coupon, but they are issued at a price lower than their maturity value or their face value. Premium bonds are bonds that are issued at a price that is higher than their par value. Then you have callable bonds. These are bonds that can be called back by the issuing institution before their maturity date or maturity. Before their maturity date. Then you have puttable bonds. These are bonds that can be sold by the investor to the issuing institution before their maturity date. How do you value bonds? This is the formula that you use. That is the formula. That is the formula. That is the formula. You can study it and then you master it. Just look at an example where we just plug in the values. Then we get that as the answer. Estimation of yield to maturity. That is the formula. Gives an estimate of yield to maturity. Yes, that is the formula. Just look at an example. Yeah, we just plug in the values and get that is the answer. So that marks the end of this tutorial. I hope you have understood. If you have not understood, you can just watch the video over and over again and you will understand everything. Thank you.